Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday? All right, hey everybody, Brian Fouts here with the Money Multiplier, and welcome to Take Back Control Tuesday. Excited to have you guys all here. Gonna have a great presentation here today for you all. Now, as we go through this presentation, feel free to go ahead and use that Q&A box or the chat box there. I will be answering questions sort of on the fly. I'll make this a little bit interactive so we can all kind of, do this together. So once again, use that chat box, use that Q&A box. We're gonna do some Q&A at the end of the presentation as well. All right, guys, now, one thing I want to explain to you about this concept, about what we're going to be talking about today, one of the number one things that we're talking about is control. So let me ask you guys a question. So what in life do you want to control? And there's three main things that I talk about typically that I believe we all should try to control as much as possible in our lives. So anybody want to use that chat box? Give me something you think that we should control in our lives. Keep in mind, there's three things, and we're going to be talking about those things in this presentation. So Michael said money. Absolutely. Money is one of the big ones. Time and money. So some of you guys may have heard me talk about this before. Our emotions, right there. Okay, you guys just nailed them all right there. So time and money are a big one. So the most common answer is going to be money. Money is just, but here's the thing though. Money is just a tool. It's just a resource. But when you control money, it allows you to control other things in your life, such as time, right? So when you control money, you can control your time. So like as an example, I'll share with you guys, I travel quite a bit during the summers. I'm in northern Idaho right now. I'm in an RV, my father-in-law's house. We're traveling. I live in Washington State, but I love to control time. For me, time is the big one. But there's a third one. And thank you, Shauna, for my birthday wishes. Thank you. Yeah, but there's a third one. And this one to me typically comes before time, and it comes before money. And that's our mindset. Because when we're born in life, do we know right or wrong, left or right, good or bad? No, we don't. Do we understand money? Do we understand time? No. That's something that we are taught. We learn that from experiences, from those around us, from the influences in our lives. And those essentially can steer us to where we're at today. And so if you want to have control of more money and you don't, or want to have more control of time and you don't, you have to first address your mindset, or money mindset as we call it. And so we're going to be talking about that in this presentation, because once you flip that switch in your mind around money and time, it's hard to go back. So we're going to get into that here in a little bit. Now, I want to share this quote. This is a quote that we here at the Money Multiplier really like, because it's just so simple. But the quote is this by Will Rogers, and it says, "The problem in America isn't so much what people don't know. It's what people think they know that just ain't so." So this is a great quote, and if you think about it a little bit deeper, it's really powerful. But that's a quote that we really like. Now, something else I want to share with you is this. Let's say you take 100 18-year-old kids or 17-year-old kids, right? And you put them into a room and you ask them all one question. Will you be successful at the age of retirement? What are they going to say? Of course they're going to say, yes, I'm going to be successful. I'm going to be wealthy. I'm going to be a millionaire. All these things, right? They're going to be wildly successful. Yet, here's the reality of that. If you fast forward to retirement age, let's say 65, only five out of 100, 5% of those teenagers will be financially secure in retirement age. And I don't mean financially free, by the way, or wealthy, just secure. 95% of them are not going to be financially secure in retirement. And yet here we are in America, supposedly one of the wealthiest countries in the world, and yet only 5% of us are going to be secure at that point in time. That's crazy. That does not make any sense. And so why is that? Well, one is because what we're taught. It's one because what we think we know that just ain't so, right? It's those kinds of things, but it has to do with our mindset. It's a lot about mindset. And so the concept that we're going to be talking about here today in this presentation is one of the vehicles that wealthy people, wealthy families, and middle class average Americans use to become one of those 5%. So give me a yes in the chat box if you want to be one of the five. Do you want to be one of those 5% or five people that is secure? Now, I recommend being financially wealthy, right? Financial freedom. But do you want to be one of those five or one of the 95? Yes, Kurt says yes. Serena says yes. Absolutely. We want to be one of those 5%. And that 5%, by the way, it's not something we just make up, right? It comes from the Social Security Administration. They actually state this, that 5 out of 100 people will be financially secure at retirement age. So as we go through the presentation, what I'm going to challenge you to do is keep an open mind. Keep an open mind about what we're talking about this concept that can really change your life, change your financial future, change it for the next generation, and by the way, even 3 generations down the road for you by being one of those 5%. All right, now before we get into that, I want to share something really quickly about who I am. I'm not going to talk much about this, but in life, I followed that traditional path. I went to school, Washington State University. I got a degree in construction management and business because that's what I thought I was supposed to do. And I went and got that degree, paid probably $75,000 for it or something like that. I haven't used it in over 10 years now, but I call that the hard way. And that's where a lot of people are. They think that we have to go do that. I was raised lower class. My parents, we had a home that didn't have we didn't use the heat very often in the wintertime. So I always had to do, wood fires in the mornings when it was, 30 degrees outside to keep warm, that kind of stuff. But great family, all that kind of stuff. But I was following that traditional path in life. I was told, go to school, get a job, save into your 401k. And I did all of that. That's exactly what I did. I was stuffing money into a 401k and then I watched it just get crushed over and over again. It happened like, I think 2 to 3 times in the span that I had it where I lost value. And I was like, man, this is hard. This is not working. Right. But I had that house and that growing family. So I had the car loans, I had the mortgage, student loans, by the way, credit card debts, all this kind of stuff. And I was told I had that American dream. And I'm like, this does not seem like a dream. It seems more like kind of like a nightmare, to be honest, because I felt like I was just keeping my head above water, barely just making ends meet. And one time I was in a doctor's office and they had this financial magazine on the desk. And they had them on like the coffee table there. And I grabbed it and I opened it up randomly to a page and it was talking about like millionaires, how they know their net worth. And I realized, well, gee, I don't know my net worth. Okay. So maybe I should figure that out. So that's the paper right there. I don't have it anymore. I lost it, but I took a picture of it years ago. But I did the math really quickly and I realized I was worth a negative amount of money. And then I did the math even more and said, next year, I'm going to be worth even less amount of money. Like this, like what is going on? This makes no sense, but I'm doing what everybody else around me is doing. And I realized, well, nobody that I'm looking at around me is where I want to be at their age. So I realized something had to change. And then I had sort of one of those unfortunate events that sometimes we have in life. And it was my grandfather. My grandfather was my idol. I love this guy. He was a pillar in the community. We've always known those kinds of people, right? So he was a coach and a history teacher at the local high school. He taught his son, my dad. He taught my older brother. And he retired right before I got there. But man, everybody loved him. And he was working very, very hard and into retirement. He worked till he was like 66, something like that, because he wanted to retire and then travel with my grandmother, his wife, around the country to see sporting events and his grandkids' sporting events. And he did that. He retired and did that for about, I want to say maybe 2 years. And then he got really sick. He got advanced Parkinson's, some leukemia, and ended up passing away and didn't really ever get to live that life in retirement that we all dream of. And it made me realize, what am I working for? What am I working towards? How can I live my life today and in the future? And so that kind of set me off on a journey. And that journey led me to becoming an entrepreneur, getting into business, these kinds of things. And so, that was a great journey. And this is like one of my businesses, because anybody can say anything on the internet, but this is one of my businesses I acquired in 2016. And in 2021, in COVID, by the way, it did over $2 million in revenue. But that was kind of one of the cool things I did. But bottom line though, I like experiences. And so by becoming an entrepreneur, by learning the strategy that we're going to be talking about here today and implementing that, I was able to have a lot of experiences in my life. And you can see these are things that my family does. I like cars. I like classic cars, by the way. We travel quite a bit, my wife, my family and I, but that's what I enjoy doing. So controlling money allowed me to control my time. Right. So that's what I do. I love to control my time and do what I do. It's why I'm talking to you right now in an RV on my birthday, because I love what I do and I love to travel. But this has led me to also speaking about what we're going to be talking about here today. Because of what I was doing, because of the things I was, talking about, people will ask me to, hey, what are you doing? Can you please share? And so I presented on stages, presented on lots of presentations like this about this concept we're going to be sharing here today and diving into. So let's go ahead and get into it. Now, when we talk about this concept, which is the infinite banking concept, and we're the money multiplier, and so we have our own, call it, spin on this method. But who else is talking about this strategy? Because if you haven't heard about it before, and most likely you probably haven't heard about this, but who else is talking about this? Well, there's this gentleman, you may have heard about him, Robert Kiyosaki, right? Author of Rich Dad, Poor Dad. He talks about this concept in his book called Second Chance, which I recommend that book right there. Tony Robbins, I've been involved with a lot of his groups and a lot of his students, but he talks about it in his book, Money Master the Game. That's a great book, by the way. I really like that one. Some parts of it are really good. And then, of course, Becoming Your Own Banker, Unlock the Infinite Banking Concept by Nelson Nash. Now, Nelson, he was the gentleman that really popularized this concept. So if you have not read that book, I strongly recommend you get it. You can get it on Amazon. I'll have my copy sitting right over here. It's always with me. But that is like the one book I recommend strongly. If you haven't read one yet, that's the first one. Then, of course, we've got two other ones. We've got Mapping Out the Millionaire Mystery by Brent Kessler and Chris Naugle. They're my mentors, by the way. And if you guys want, by the way, that book and the next one, which is called The Private Money Guide, the real estate edition by Chris Naugle. If you guys want those digitally, just send me a message. I'll give you my email address at the end of this presentation. And I'll send those bottom two to you digitally, so you can have them. They're free, no cost for you. So, but if you can, if you want, take a snapshot of this page, because these are books that I do recommend you take a look at, just for your mindset, by the way, because they're very educational and have a lot of good things inside of them. Now, who else has used this concept, this strategy through history? Because it is not a new concept. This has been around for a long time, by the way, not longer than 100 years. This concept has been around longer than the IRS, longer than our tax code has been around, right? So it's been tried and true. So who else uses this? Well, Jim Harbaugh, or however you say his last name, I can never pronounce it correctly. He was actually one of the top paid coaches, but they used this concept to actually pay him and to help him create even more wealth. And if you can go read the article on it and how they did it, it was amazing, very cool way that they did this. And there's a reason why they did it. If anybody wants to have a conversation with me about why they did it this way, it's very fascinating. There's this guy. Now, he may not know who his name is or what his name is, but his name's Joe Biden, President Joe Biden, by the way. When he became president, he had to disclose that he had 4 of these policies, of these strategies in place. Disneyland. So Walt Disney, when he wanted to start Disneyland, he was going to banks, and he went to dozens and dozens and dozens of banks, and he got denied. So he finally used his infinite banking concept, the policy he had in place, to fund Disneyland. And that's how he started Disneyland. So without this concept, Disneyland, or Disney World as we know it today, may not have ever existed. That's how powerful this thing is. Additionally, McDonald's hamburger. So Ray Kroc, who he took over essentially, or partnered with the McDonald's brothers, depending on how you want to look at it, by the way. But when he wanted to expand McDonald's back in the 50s, he used this concept to pay for salaries, fund the business for cash flow and things like that during the first, I think it was 8 to 10 years. So without this concept, McDonald's may not exist, right? Additionally, Pampered Chef. So she used $3,000 from this concept, from a life insurance policy, as we'll explain here in a bit, to start Pampered Chef. And I think Warren Buffett got it for 1.5 billion. that's a pretty good return right there. And then wealthy families. So the JPs, the Morgans, the Chases, the Vanderbilts, as Michael said, the Rockefellers, right? And the Harrises, all these families use it, and now you can use it as well, because we've helped. Well, I'll get into that. We've helped thousands upon thousands of families use this concept. Now, why though? Why infinite banking? So what will infinite banking do for you? So here's some things that it does. So one, it creates guaranteed, I love that word, by the way, guaranteed generational wealth day one. Not year 30, not year 5, but guaranteed generational wealth, tax-free, by the way, tax-free day one. Okay. It allows your money to grow uninterrupted, compounded for the rest of your life, guaranteed once again, right? I think it was it Einstein who said like the compounded interest is one of the, wonders of the world. Well, this does that and it's guaranteed as well. It allows you to take control of your money. Remember control? I talked about that at the beginning. So this allows you to take control of your money away from the big banks and Wall Street and puts that control into your hands. So once again, control is powerful. Control your money. This is one of the big things this concept does. Protects your money from lawsuits, bankruptcy, divorce, and creditors, not credits, but creditors in most states. So if you make your money, you also want to protect that money. And so this does that as well. And then it allows you to be the bank for things that you may normally use a bank for. So think of things like real estate investing, college, cars, homes, investments, retirement, by the way, while still having all the benefits listed above. Now, a lot of concepts or strategies, they'll do one of these things, maybe two, but usually just one of these. This does all of these at the exact same time, not one or the other, all of them. So I want to see if you guys are listening. Give me a one in that chat box. Give me a yes. Give me things like that if you'd like to have all of these things in place in your life at the exact same time. Does that make sense? Yeah, Michael said one right there. Anybody else want to have these things in your life? Give me a one. Give me a yes. Give me, do you guys want to have these things? Serena says yes. Judy says yes. Awesome. Greg says yes. He says one. There you go. Because when you have all these things in place, do you think you can build wealth faster? Of course, right? If you can do this and this, not just one or the other, but all of these things at the same time, you can build wealth faster and safer and more secure. So, as I said, guys, if you guys want to take out a pen and paper, take notes, that's fine. If you guys want to use the chat box, the Q&A section, do that as well. And if you guys want to reach out to me after this for any questions that maybe we don't cover or you come up with after the presentation, I'm more than happy to hop on a call, more than happy to have you reach out to me, and we can go through the questions. Now, at the beginning of the presentation, I talked about mindset, right? And so mindset is big when it comes to this concept, infinite banking. So let me ask you a question. Who learns quickly? Well, kids, right? I've got 3 young kids, 13 and under, and they learn quickly. And so when you were young, you probably learned how to ride a bicycle. And it's one of those things, though, that once you learn how to ride a bicycle, if you haven't ridden one in years, you can typically hop on a bike and ride it again, right? You understand, you push the pedals, it goes forward, turn the handlebars to the left, it goes left, etc. Now, here's the thing, though. What if you had a backwards bicycle? Okay, this is the backwards bicycle. So what if your bike did not work that way anymore? What if when you hopped on that bike and you turned the handlebars to the right, the tire went to the left, or vice versa? You turn the handlebars to the left and the bike goes to the right. Well, that's called the backwards bicycle. After this presentation, go ahead and Google it. You'll see some YouTube videos. It's pretty funny. But bottom line is this, is that when the gentleman in the videos tries to ride the bike, he can't. He falls right over. He can't do it because his brain doesn't understand that anymore because he's learned a certain way to ride the bike and now it's different. So it takes him quite a bit of time, but eventually he can ride the backwards bicycle. He turns the handlebar to the left and it goes to the right, but he figured out how to do it. So it's pretty cool. Now, here's the interesting thing. What do you think happened when that gentleman got back on a regular bicycle? He couldn't ride it. It was very challenging because he had changed his mindset. He learned a different way to ride the bicycle. So during this presentation, what I'm challenging you to do to have that open mind is we're going to be talking about a different way about money. You're going to learn a different way about money, how it works. And the thing is that when you learn that way, it's very hard to go back to the original way of thinking about money. And so once your eyes are opened, you can't close them again. It's that kind of a thing. So once again, just keep that open mind about this because we're going to be looking at a different way about money. All right. So let me ask you a question. Why aren't more people successful? So we call this the mysteries of money. So there are wealth killers in our lives, and we got to be aware of what these things are because oftentimes we're not aware of these things and they're literally stealing wealth away. So the first one is taxes. Now, I don't mind paying taxes, but I'll be honest, I love paying less a lot more, right? But taxes really can steal wealth. Inflation is that secret killer because inflation is always there and is caused by the government, by the way, and the way that they handle money. It's also caused by the banking system. And so once you understand how inflation works, it's really hard to want to have your money in a bank or want to have the government controlling your money, because they're actually eroding the value of your money through inflation, through the fractional reserve banking and the monetary systems. Volatility. So volatility really does kill wealth. Let's say that someone tells you that your average rate of return on your 401k is 8%. The average rate of return is not the actual return. The actual return might be 4%, 3%, 5%, but the average is 8%. So volatility really reduces the rate, the returns you get on your investments. Interest. So interest is one of those things that really destroys wealth for a family, because it's always there. We're taught to use debt or leverage to live our lives, but that steals wealth through interest. And this was about, I don't know, I think it was before COVID, but the average family, American family, was spending about $21,000 or $22,000 a year on interest. Think about how that adds up over time, right? Yeah, and Michael said right there, debt, overspending, taxes, yep, all those things. Now, mindset, as I said, mindset, right? Mindset can really affect the way that you think about money. So once again, following that status quo, keeping up with the Joneses. Fear can really allow you to lose money or not make money, or not be up to your full potential, because fear around money is a big one. Fear of losing, right? Life in general happens, right? So as we go through life, we learn things about money, we develop our mindset, and that can allow us to, not understand how money truly works, and then what we're taught. So like if you have entrepreneur parents or very successful, wealthy parents, you're going to learn something different than maybe another person who didn't have that kind of upbringing, right? So what we're taught as we go through life can really kind of steer our direction when it comes to money. So let's kind of talk about really quickly, what is the definition of money? Well, money is just a means of exchange. That's all it is. If the government, because right now our government is, our dollar is backed by the promise of the government. Well, what if we had seashells instead of dollar bills? Same thing, right? It's just a means of exchange that we give value to. Now, this is a great question. What company uses compound interest? Do banks use compound interest? No, they charge you interest, but they don't use it themselves. Because if you write your name on a $20 bill, went to the bank, gave that bill to the teller, they don't just go into the back and put it into a box with your name on it. No, they don't. That bill goes into motion. So they make money off of your money. And we're going to talk about how they do that, because if we want to be our own banks, right, we got to understand that. Now, there really isn't a business that uses compound interest in the way that we're going to be talking about it. Next question is this. Are your dollars worth more today or in the future? Like, is a dollar bill worth more today or in the future? Think about that. Okay, it's worth more today. Think about how many candy bars or candy, a dollar bill could have bought today versus 20 years ago. Okay, so a dollar, your money is worth more today than it is in the future, right? Will taxes go up or down? Now, that's kind of almost a joke question, because yeah, I don't think the taxes are going to go down. Look at our national debt, $35 trillion, I think is what I just saw here this week or last week on it. It's insane. Like, so can they reduce taxes? No, of course not. They want to raise them. They always do. Now, would you ever wait to eat bread or milk? This is kind of a weird question, but let's say you went to the store and bought some bread or bought some milk. Would you go and put it into the freezer and then wait 5 or 10 years to eat that bread or drink that milk? Maybe it doubles. Maybe instead of having one loaf of bread, 5 years down the road, you have 2 loaves of bread in your freezer, but they're both freezer burned. No, of course not. You're not going to do that, right? You're not going to go do that. As an example, would you go and buy a car with cash, put it in the garage for 5 years, and then drive it? No, of course not. Okay? Because here's the thing. We do things with money, right, that we wouldn't do with things that money buys. So we take our money, we put it into a 401k or something like that, another vehicle, and just we don't use it. We wait to use it down the road when it's going to be worth less. But we don't do that with things that money buys, like a car or food, right? So there, got to kind of keep that in mind. And then what do you know about your retirement account? So let's say it's a 401k, okay? A 401k is essentially you giving up good dollars today for weaker dollars down the road that you're going to be taxed on down the road. Okay. And oftentimes most people have more tax deductions today while they're working than down the road. So what's that mean? Additionally, when you have a retirement account, do you control it? Remember, control of money. If you have a 401k, IRA, pension, other things, nothing wrong with them. I'm not saying don't do those things, but I'm just saying understand control. Do you control those? No, you don't. The IRS, the government, they are controlling your money. Because here's the thing, when you have a retirement account like that, who is taking the risk on a 401k and with mutual funds? Who's taking the risk on the money? It's not the 401k provider, it's not the market, it's you. You're taking the risk, yet you have no control. Makes no sense when you think of it that way, right? Okay, now we're going to look at how money flows. This is really how money flows when it comes to the bank. Okay, so let's say you want to buy a car, and let's just say that car is going to be $25,000. Doesn't matter if it's a Honda or a Ferrari. Let's just say it's a $25,000 car. And let's say you happen to have $25,000 of cash in the local bank earning 4% interest. Okay. And let's say you say, okay, I'm going to go to the bank and I'm going to say, Mr. Banker, I want to take the cash out of the bank and go buy the car with cash. Okay. Now the banker says, well, wait a second. Before you do that, I have a proposition for you. What if instead of you taking the cash out of the bank and going and buying the car with cash, I give you a loan for $25,000 at 6% simple interest, and I use the $25,000 cash in the bank as the collateral for the loan? So what's that look like? Okay, so they're going to give you $25,000 loan at 6% for 60 months, 5 years, and you're still going to have the $25,000 in the bank earning 4%, let's say 60 months. Okay. Now, what's the monthly payment? On the car, it's going to be $483 per month. Okay. The future value of those payments over those 5 years is $28,999. Let's round up a dollar and say $29,000 for easy math. Okay. So $29,000. That's the future value you're going to pay on that loan for that car. But what's the future value of your money in the bank? It's $30,525. Okay. So you've made $1,526. Yet here's the thing. You are paying 6% and earning 4%. So you made more money paying 6 while earning 4%. Because in that scenario, you're on both sides of the equation. You're on the banking side and the lending side. Okay. So that's how that works. So once again, kind of keep an open mind. This is how this can work. Now, you might be saying, why is that? Why does this work? How does this work? Why does that happen? How did I make money while paying 6%? It's because as you make the payments on the car note or the car loan, the balance of the loan is decreasing. So you're accruing 6% on a smaller balance, while in the bank, you're earning 4% on a larger balance. So that's how interest works, right? So understanding interest, understanding compound interest and simple interest, very powerful when it comes to becoming your own bank. Now, let's talk about the money multiplier method. This is what we're going to be going through next. So the first part of this is going to be what we call the machine. How does the machine work? What is this vehicle? Next up, we're going to talk about the marathon. This is a marathon. It is not a sprint. Building wealth like this, yes, there's going to be some time involved. And the last one is everybody's favorite topic, right? The millionaire. How to use this method to become the millionaire, to become a millionaire. Because if you want to live that, that retirement life that's just full of, of experiences, and you control your time, money, that's where we want to be. Let's dive into the machine. So what is the machine that allows infinite banking, this concept, to exist? It is nothing more than a permanent life policy called a dividend paying permanent whole life insurance policy with a mutual insurance company. That's it right there. And you might be saying, well, why insurance? Why insurance? Well, because when I was young, by the way, when I was young, I never thought that, oh, I have to have life insurance, right? Because I'm just thinking death benefit, that kind of stuff. But with the infinite banking concept, this is just the engine that allows the vehicle, infinite banking, by the way, the car, if you want to call it that, to go down the road. So this is the engine that allows that car to run, to function. Okay. Now, one thing I want to mention about life insurance, about this thing, is like who uses life insurance? Well, we all use insurance of some kind. Now we're going to get into some more aspects of this, but who's the biggest purchaser of life insurance? So we're talking about becoming the own bank here in this presentation. How do I become my own bank? Well, guess who's the biggest buyer of dividend paying permanent whole life insurance? It's banks, by the way. As Michael said right there, it's banks. Bank owned life insurance called BOLI. If you want to Google it after this call, go ahead and Google it and you'll see what they are. But banks buy life insurance, a lot of it. In fact, they own more life insurance than they do their buildings and real estate combined. And since 2016, they have quadrupled their holdings. So I wonder why they're doing that. Do they know something that we don't? Maybe. So what we're talking about with this concept is just doing the same things, by the way, that banks are doing with our money. So once again, I'm going to say that I'm going to repeat myself again. We're going to do the same things with our money that the banks are doing with our money. Okay. And really, all we're going to be changing is where our money goes first. Because when money comes in, it goes right back out. Bills, expenses, debts, all those things. So with this concept, we're going to change one thing, where that money goes first. Okay. So we already talked about this. Can you make money earning 4% while paying 6%? Well, I showed you the math, and the answer is yes. Now, why is that? It's because you are the bank. You're on both sides of the transactions. So before we get into how this one works for you, what we want to understand is, how do banks work? How do banks function? How do they make money? And by the way, they're making money off of our money. So let's just say that we put $100,000 into a bank, and let's just say it's one of those nice accounts. They're going to pay you 4%. Okay. Now, does the bank sit there with your money in their hands? Of course not. They can't do that because they can't pay you 4% without doing something with your money. So what does a bank do? Well, they take that money and they loan it back out, maybe on a mortgage, maybe a home loan, maybe a 7-year ARM mortgage loan, 7% maybe. But here's the thing, when you go and buy that home with that mortgage and the seller gets that money, what does the seller do with that money? They don't sit on it. They put it right back into a bank usually. What's the bank do? Same thing once again. They loan it back out. Maybe this time it's on a car loan for, let's just say 8% or something like that, a high interest car loan. What's the car company do? Same thing, right? They take that money and put it right back into the bank again. But what's the bank do? They loan it back out. Maybe this time it's on a home remodel. Maybe it's a construction loan at 9%. But what does the contractor do? What do the subcontractors do? What do the employees of them do? Same thing. Money goes right back into the bank again, repeats the cycle. Bank maybe lends it back out at maybe debt consolidation at 12%. What's the credit card company do? Puts it right back into the bank. Now, notice this on this slide right here. Who's in control of all the transactions? Who holds the paper? The bank does. The bank is in control of all of these things. They're earning interest on your money multiple times over and over again, to the point where they're going to be earning 500% more than you, because they're going to be earning 20% while paying you 4%. So that's how a bank makes money. Now, you might be saying, well, if they make so much money, how do they go under? Well, banks, they have other practices they do that are very risky outside of just this, that we don't do. But this is how banks make money. And if you guys want to see how much they make, it's right there. You can go to bauerfinancial.com and you'll see there that they make between 400 and 1,300% on the money that you leave there. So that's crazy, by the way. And you can go look at bauerfinancial.com and you can go back 20 years and see how much banks have made on your money. Because there's not a bank that has made less than 400% annually on your money. And so think about that, though. Why is that? Well, go look into any town, go look on the corner, and you'll see banks on every corner, right? They have the nicest buildings, they have nice offices, and that is us. It's you and me paying for that. And it's kind of interesting. Whenever I go to, I was at a bank here a couple of months ago, and I was cashing a check, right? Because we still have to use banks for certain transactions. And I was cashing a check, and there's this little cup next to the teller where I was standing, and it has these suckers in it called dum-dums. And it's just kind of funny because I'm sitting there giving my money to the bank. I'm like, man, I feel like kind of a dum-dum, and there's the dum-dums in there. And I took a picture of it and I sent it to our team with like an emoji because it was pretty funny. But think about that. That's what banks do. They make money off of your money. Okay. All right. Now, next, I want to talk about the annual pattern of spending. So how do we spend our money? How does the average American, average Canadian spend our money? Okay, so let's look at how our money is going out. So of every dollar that comes in, 20 cents goes out to automobiles, payment, gas, tires, upkeep, things like that. So 20 cents of every dollar to automobiles. 30 cents of every dollar goes to housing. 30 cents. So think of like mortgage, rent, things like that. 40 cents of every dollar goes to things like travel, entertainment, food, everything else, right? So 90 cents of every dollar goes to somebody else, helps them build wealth, right? And what's left? Around 10%. 10% goes to savings. And I think right before COVID, I think about 3 years ago, no, during COVID, that number was more like 5 or 6%. And then before COVID, it was a negative number for a while, kind of scary. So it was a negative number. So I'm not going to talk to you about what you're saving, that 10% number, because when you go and talk to, let's say, a financial planner, they're going to talk to you about your savings, not what you're spending, but your savings. They're going to say 10%. Okay, let's go put it into this, etc. Put it into risky things so you get more returns, etc. I'm not going to talk to you about what you're saving because we want to save more through becoming our own bank, right? So let's look at what that is. So there's your savings. Now, here's the thing. On average, as I said, people spend 20 cents of every dollar on autos, but here's the thing. 5 cents of that 20 cents is interest. So when you have a car, 5 cents of every 20 cents is going to the automobile company. So what we want to do is recapture that. We want to recapture the interest. We want to put that 5 cents back into our savings. I'm going to show you how we do this. Next up is housing. Now, housing is a bit different because 25 cents of the 30 cents you spend on housing goes to interest. How is that? Well, think of an amortized mortgage. Amortized mortgages are what I call scammy math because you're taught, or we are, programmed, subconsciously programmed that, hey, a 3% interest rate on your mortgage is great. Well, if in the first 7 years of that mortgage, 80 cents of all of my payments go to interest, how is that 3.25%? Makes no sense. The amount you pay on that loan is staggering over 30 years, right? So the very high interest, even though they sell us on low interest rates. So we're going to take that 25 cents and put that into savings. Next up is everything else. So I said 40 cents of your dollar goes to everything else, and about 5 cents of that goes to interest. So let's take that 5 cents and put it back into savings. Okay. So now what have we done? We have changed the way we are paying out interest to other people by recapturing the money back into our control. So we have essentially built up our savings. Does that make sense? So now we actually have that money back into our control. Once again, control. If you're paying interest to other people, you're giving that money away. There's no future value of that money, right? So let's say if you have a car loan and you're paying, $500 per month on that car loan, how much of that $500 do you have left? How much of the $500 do you control? Zero, right? Zero. So next up, I want to show you how you can gain back control of that money for things that we buy, which is things like a car. Okay. So this is how to get all the money back for every car you'll ever buy, drive, and own. Now, that's a cool car. I like classic cars, by the way. That's a Mustang. I actually don't have that Mustang anymore. I used to. I have a 67 Mercury Cougar, by the way. So I love classic cars, though. All right, so this is the machine. Let's look under the hood first, and then we're going to go into an example of how you can buy a car with this concept and actually make money. So on the right-hand side right there, you're going to see an example of an infinite banking structured policy. And we're going to see things on there. And I'm going to go through these numbers in a moment here. So now when we think of insurance, like we think of car insurance, home insurance, health insurance, premiums, those are an expense, right? Because once you spend the money goes out, you're not getting anything back in return unless something unfortunate happens, right? And we don't want that to happen, right? So this is different. So we call these premium deposits because when you deposit money into an infinite banking policy, you can use it. You can borrow it back out again and leverage it for other things that you would maybe use a bank for, like buying a car. So I don't want you to think of the premiums as a bill because you're going to funnel the money through a policy first and then take it right back out and go use it. Put that money to work. Like the one thing we always say is money in motion makes money. Okay. So it's liquid, by the way. So this is a liquid asset. And by the way, that is for the government. They consider these to be a liquid asset. Okay. Next up is age. So a lot of people think, well, okay, life insurance, expensive, age, I'm too old. Age doesn't really matter. Now, it does affect the death benefit, but we have people that are in their 60s, in their 70s doing this concept. So if you have that thought in your head, you can just get it out of your head. Next up is death benefit. So when people think of life insurance, they immediately go to death benefit. Well, guess what? I'm not going to be talking about death benefit as the main focus. It is a benefit. It's a secondary benefit, but it's not the main focus because we want to look at the living benefits of this concept. That makes sense? So we want to look at the living benefits of infinite banking. Okay. All right. So let's go and look at the machine and how it looks for a car. So I'm going to go through an example here. So we have a policy. We're going to put in a deposit, a premium deposit of $10,000 per year into this policy, this infinite banking structured policy. Okay. And then we're going to do it for 7 years. Now, at year 3, we're going to buy a car. Now, here's the interesting aspect of infinite banking. Every deposit that you put into the policy is going to earn you cash value. Cash value is what you can borrow against or leverage against to take out. So in year 3, we're going to buy a car for $25,000. So what we're going to do, we're going to go to our bank, right? And we have a guaranteed loan because we are the bank. Take that money out. It's now cash. So think about that. So you put in, like, say, $30,000, but now you have $25,000 in cash in your hands. Now, in this example, we're going to talk about buying a car, but guess what? It could be invested into real estate. It could be paying off debt, which we're going to talk about here in just a moment. It could be something else. It could be college, but I'm going to use a car because we've all probably bought a car before. Now, because we are going to be responsible bankers, we're going to pay ourselves back, pay our bank back. So I'm going to do it at $500 per month with interest, so $6,000 per year. So what do these numbers mean? So at the end of the 7 years, we've put in $70,000 into this policy. We've also put in $30,000 for the car payments to pay back the loan to our policy. That's $100,000. All right. Now, we also took out $25,000 in cash. So we had $25,000 in cash. Okay. So we had $25,000 in there. And now Michael, he said, Brian, he wants to ask a question. So I'm going to pause you for a second. So he says, you didn't have $25,000 to borrow. Yes, we did. Inside the policy, we did. Now, you might not see in the math exactly, but at the end of year 3, you'd have probably around $25,000 of cash value based upon the $30,000 going into it. So that's because the compounding will start to take effect. And so you're seeing on the cash value in the account, you're just seeing it drop down in year 3 because we took the money out. Now, the cash value, by the way, is still in your account. It doesn't literally come out. It's just leverage. It's like collateral for like a loan, but it doesn't come out. And I'll explain that here in just a moment. But good question though. Yes, you can, of the cash value. Can I borrow every dollar? Yep, of the cash value. Yeah, and you'll see. I'm going to show you some examples of where the cash value is higher than the premiums that you put in, and it's pretty cool. So Jeff, I mean, you probably can. I mean, it depends on your situation. So, but good question. But that's why I recommend if this is something you want to pursue or look into to see if you can do it, schedule a call with me and we can go through it. So back to the car example here. And by the way, guys, keep asking questions. Now back to the car example. So because we took $25,000 out in cash, we put 100 in, took 25 out. Really, it was $75,000 that went into the policy. Okay. So what we've done is we've actually recaptured 91 cents of every dollar because the cash value inside the account is going to be very high. And so we've recaptured 91 cents of every dollar in this concept, but it gets even better. So now let's go to the next set of years. So this is years 1 through 7. Let's go to years 8 through 12. So the next 5 years. Now in this scenario, we don't put any more deposits in. Now this is an optional thing, by the way. You can stop putting in premiums if you want after you're typically 7. I typically recommend that you do, but you can. So no more goes in after year 7. Now, here's the fun thing. Because of compound interest, it's still growing. Your account is still growing. And so let's say in year 8, we decide to buy another car for $25,000. So we go and we take $25,000 out of the policy. That's cash. And we pay the loan back same as we did before at $6,000 per year, $500 per month. So at the end of this period of time, we put in $30,000 into the policy, or the loan payback, but we took $25,000 out. So in reality, we only put in $5,000 into the policy, but the policy between years 7 and 12 grew by $23,000. Okay. Next up, how much have we put into this policy overall? We put in $75,000 in years 1 through 7. We put in $5,000 in years 8 through 12. That's $80,000. But what's the value of the cash value in the policy? It is $91,473, meaning that we have more cash in the policy than we put into it by about $11,000, by the way. And we bought 2 cars for $25,000 each. So Michael, say that again. Okay. So how much did we put into this policy? Yeah. Okay. So if you look on the left-hand side, we put in $75,000 in years 1 through 7. Okay, because we put in 100 to 25 out. Okay, so we put in $75,000 because we took 25,000 out in cash, had that in cash in our hands. Okay, in years 8 through 12, we put in 30,000, but took 25 out, so we only put in $5,000 into the policy. So 5,000 plus 75 is 80. So we put $80,000 into this policy over 12 years. Yet the cash value available to leverage is $91,473. So we have that sitting there, right there, that you can use it to go do whatever you want. You have $91,000 right now. You can go, go on a vacation. You can go buy a real estate property, down payment on a house, invest it, private lend it, whatever. And you have 2 cars fully paid for. So once again, $91,000 in there, and you have 2 cars you paid for. So would you rather have paid $25,000, $50,000 total for 2 cars and have the cars and nothing else, or have $91,000 and the 2 cars, right? Anybody want to give me a 1 in the chat box if you guys want to have that versus the 2 cars and nothing? So that's how infinite banking can actually pay for your cars, right? It's very, very powerful. And that's just one example. And this was something that you would typically use a bank for. But imagine if you were doing something that cash flowed, like real estate, like private lending, right? Starting to kind of see how the mindset is starting to change a little bit here. Okay. All right. So when it comes to infinite banking, there's kind of 3 rules that we follow. One is pay yourself first. Because here's the thing. We've been trained to pay your bills first, then you take whatever is left over and you put that into savings. But that's the wrong way of thinking about money. There's actually even a book called Profit First, which is for business though, but same kind of concept. Pay yourself first means you put your money into savings or infinite banking first, then you pay your expenses for the banking transactions. Okay. Second rule is pay yourself with interest, because if you're going to go get a bank loan for something, you're going to pay that loan back with interest. So if you're going to be your own bank, do the same thing. Pay yourself back with interest, because since you are the bank, you're a fractional owner of the insurance company, by the way, because that's a mutual insurance company. You're going to benefit. That's the dividends we'll talk about in a moment. So you want to pay your bank back with interest. And then recycle and recapture your money. So what I mean by that is that you want to, if you're going to pay interest to somebody else, recycle it back into yourself. Okay. You want to recycle and recapture your money. Because if you don't do that, money is just flowing out of your life. It's just flowing out, flowing out, flowing out. With infinite banking, it flows through your policy first, you capture it, and then you go do the transactions. But you've maintained control first. Okay. Lavinia said, is this compounded interest? Yes, it is. Yes, it is. So inside the policy, and I'll show you some examples in the illustrations in a moment of how that works. Yep. Now, this works for a car. What else? What's one of the other things that really steals wealth? We talked about it. It's interest. It's debts.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com. Sign up.
So I'm going to go through an example, and this is a case study that we built on a client, and this client has some significant amounts of debt. So it's a doctor. This doctor is 45 years old, 9 third-party debts, by the way, $478,000 in debt, and that's a lot, right? And so total payments on the debts were $5,777 per month, or $69,000 per year. Now, if this doctor paid these debts off just traditionally, right, paid them off traditionally, it would take 19 years. Now, do you think this person's going to incur any more debts in those 19 years? Absolutely. But if they stopped incurring any more debt and just paid these things off straight up, it'd be 19 years. That's a long time. So what we're going to do is look at an example of how infinite banking can drastically change the situation. So he starts a policy. It's going to be an annual premium of $25,000. So his deposit into his policy is $25,000. Now, this is a very conservative policy. Most likely, they're going to have a lot more cash value, but I want to be conservative, right? On this illustration here. So the cash value within the first 30 days that they have available is $14,863. By the way, first 30 days, not 3 years down the road. If somebody who's telling you they can do infinite banking or do cash value, and they tell you that the policy has no cash value in the first 3 years, run away. Run away, okay? Because this is in the first 30 days. So what does he do? So following our plan, by the way, and I'll talk to you about that in a moment. Following our plan, he takes that money out and he wipes out the Discover card, the Lowe's card, and part of the Nordstrom card. Okay, so he takes the cash value out as a loan from his policy and takes out some of those debts, and he does it strategically. Okay, now that reduces his monthly payment by $448. Now, becoming a responsible banker means that that $448 that you have coming back out, or that you're not paying to the debts anymore, you want to recapture it, right? You want to recycle that money. So what do? We take that money and we put it back into the policy loan, or you can put it into a separate account, a segregated account, either way. So what's that mean? That means that in year two, once again, premium deposit of $25,000. Now, because of compound interest, it's going to grow faster and faster. Cash value is now $16,571 available to borrow, and the payments of $448 back to himself is $5,374. So the total cash that he has available now is $21,945. Same thing. He borrows from this, right? Borrows from this policy and goes and pays the Nordstrom card, the Wells Fargo card, and the private loan, and part of the BMW. His total debt has dropped down to $378,000. Okay, right? The monthly payment, though, has now dropped down to $1,917, or dropped down by that much, and he's paying $3,860 every month still to the remaining debts. But what we do, once again, recycle the money. We take the $1,900 and we put it back into our policy or into a separate account and capture that money. So now year three, what happens? Same thing. $25,000 goes in, cash value grows by $25,541, and the payments of $1,917 back to ourselves equals $23,004. So the total cash value available is now $48,545. Same thing happens again. You take the money back out via the loan provision. In this scenario, he pays off the BMW, pays off West Marine, probably a nice boat right there, and pays off a portion of the condo. Now, total debts have dropped down to $283,000, which is awesome, in only 3 years, by the way, only 3 years. And the monthly payment has dropped by $3,677. Very, very powerful, okay? Now, the marathon. So I'm going to take a break here for a second before I get to year four. I want to ask a question. When you think about this, how much have I, in this example, how much have I put into this policy? Well, years 1, 2, and 3, $25,000 each. That's $75,000. How much have we taken out of the policy? Approximately $55,000. So how much is left in your policy earning you the dividends? So keep in mind that with these policies, you're earning dividends because it's a mutual insurance company. You're a fractional owner. They're profitable. They pay dividends. How much are you earning dividends on if you put 75 in and took 55 out? A lot of people will say it's $20,000 because I've taken $55,000 out, but that's not the way this works. The $75,000 is still in your policy, still earning the dividends. So, yep, as Kevin said and Derek said, you're earning those on $75,000 at the same time you took this $55,000 out and used it. Like that's a mindset shift right there for a lot of people, saying, well, wait a second, because if I have cash in a bank, 100 grand, and I take 25 out, I've only got 75 left. This is different because you are your own bank. So your cash value is collateral for a loan. That's what's happening right there. Okay, so I want to make sure we note that right there, because that 75 is going to be always earning 5 to 6%. And the dividends can change a little bit, but that's what they are right now. And okay, Michael has a great question here. I'll pause before I get to year four. So do all companies pay dividends when you have policy loans, or do you recommend certain companies? We recommend certain companies. Great question, because there are, not to get into the definitions, but there's called a direct and non-direct recognition companies. Direct recognition, they reduce the amount you earn dividends on when you borrow. So we don't do that. We do non-direct. So yeah, it's a good question though. But yeah, we work with multiple companies. All right, year four. So year four, once again, $25,000 goes in. That's your premium deposit. Cash value goes up by $26,304. Now the payments are $3,677 to yourself equals $44,000 and change. So the total cash this doctor has is $70,439. So now what do we do in year 4? We take it out, same thing. We knock out a portion of the condo and the debt drops down to $187,000. Now, this is a bit different. Now note that the payment is not going to change. That's because the condo and the house are amortized loans. Amortized loans, if you pay the principal down, the payment does not change. Okay, it doesn't change at all. So a little bit different. So it doesn't change. In year 5, once again, 25 goes in, cash value goes up by $27,090. Payments back to yourself is the same number. It's $44,124. And the total cash is $71,225. Okay. Now what do we do? Borrow that money back out. Now we knock out the condo and a portion of the house. So now the debt that is left is only the house. Okay. The monthly payment drops down to only $1,221, which is the house payment only. And you're now putting $4,556 back into your policy. Okay, so now in year 6, we're going to do something different. So in year 6, we're going to drop the premiums down to $10,000 from 25, and we're going to start a second policy. So a lot of people, once they start to see the math, and obviously we all expect to make more money in life as we go, so we might want to do a second policy. We call this policy stacking. It's very, very powerful. So in this scenario, he puts in $10,000 premium deposit into the first policy. It's year 6 of that policy. The cash value goes up by $13,092. Note that he's getting more value out of the policy than if he puts into it. And the second policy, he puts in $25,000 and has $14,863. Okay. The payments back to himself are $54,678. So the total cash available is $82,633. Okay. Now, before I say what happens next, I want to address Michael's question. Won't the policy mech if I put all the cash back in? No, it won't. Nope. Yeah, because it's into the loan. So it's going into the loan, not into the premium. That's why. So, but good question though on the mech, because the mech is something you got to be aware of. That we take care of the mech. You don't have to worry about it, but it's a good question. Called the modified endowment contract. All right. So now in year 6, so he takes out 76,000, wipes out the house. All the debts are gone. Monthly payments are now 0. And in year 7, what's he do? In year 7, he pays back his policy loan, and he is now 0 debt and has probably over 6 figures of cash value in his policies that now he can go use to go create wealth, create cash, to do other things, buy a car if he wants to. So to summarize, this doctor was looking at a large amount of payback and 19 years. And if he did that in 19 years, how much would he have in value after 19 years? 0 cash is what I'm talking about, right? He'd have the house and the condo, but nothing else. In this scenario, he paid it all back in 7 years, or got all the debts paid off in 7 years, and he has hundreds of thousands of dollars in his policy that he can now use for something else. Very, very, it's a very powerful concept, but you might be thinking, well, Brian, that sounds cool, but how do I do that? That there's a lot of numbers there, all that kind of stuff. Yeah, he saved 13 years of payments, essentially, Michael. Yeah, pretty much. It's a huge amount of money, by the way. And now I'm going to show you in a little bit later the amount. It's staggering. But we have tools that allow you to do what I just showed you, because you don't want to guess on what I just said and how to pay back your debts and do the car stuff. So we have softwares that do all this stuff, and we do this for our clients. There's no cost, no charges, nothing like that. That one was called the Debt Blaster. And it's a report that we use to show you how to flow the money through the policy and into the debts to maximize the payoffs. And right now, we compare it to velocity banking. We compare it to the avalanche method. Infinite banking beats them almost every single time. So think of it like your own personal financial blueprint. And so we have an implementation team that does that for you, that works with you on an ongoing basis to show you how to use these policies and make sure they work the most efficient way possible. Something like that, Michael. I can't remember what it is, but it's a large number. It's a very large number. Now, granted, keep in mind, he would have knocked off some of those debts during those 13 years. He would have knocked some of them off, so the payments would have dropped off a bit more over time, because some of the credit cards wouldn't have been 19 years. They would have been like 5 years. Now, let's kind of talk. Now let's go to the third section, which was the millionaire. So this is a question I get quite a bit. What if I have no bad debt? What if I don't need a new car? As an example, can I still benefit from privatized banking, or should I still become my own banker? Absolutely yes, because that's where the fun begins. So because I call it flip-flopping. It's like kind of like that point where you get kind of over the mountain and you come down the other side. Because when you have debts, when you have those kind of like, the car things, all those things, it's taking money away from you. But once you knock them out with infinite banking, and now all of a sudden you don't have those debts, but now you have this policy that you can go be your own banker for things like real estate investing, for things like cash flow, it completely changes the game and flip-flops your wealth. That's what happens a lot. So here's some other things that you can use infinite banking for. This is how you start to become the millionaire now. Now that we've gotten rid of the debts as an example, now we do this. So active real estate investors, so wholesalers, flippers, buy and hold, commercial property, apartments and mobile homes, people use them for that. Private funds, passive real estate, so things like lending private funds on the deals where you become the bank. So it's kind of funny, you're the bank twice almost. You have your own banking policy and then you lend it on to another person that is doing like a rehab as an example. Business owners, we have a lot of business owners that want to use this for multiple reasons. So think of like a line of credit for your business. Think of it like as key employee insurance, retirement planning if you own your own business and you don't have like a retirement plan through your own business, you can use this for that, things like that. Stocks and options traders do that. I've done stocks before, day trading. Startups. So we have people that use this to start up their own business, right? So rather than just take the cash and do it, they'll use a policy first and then use that to fund their business. Equipment flipping. So we actually have a group where they do equipment flipping, so like forklifts, things like that, to get a return. So lots of examples of that you can use this for to start building cash flow, building wealth. Now, what I want to do is show an example of what I just said. So I'm going to do an example of using private banking for private money lending. So think of like private lending on a real estate deal. Now, and I'm going to go through some more of these numbers. So if this is like, oh my gosh, a lot of numbers, don't worry about it. I'll break it out. So this is an example of a person who has a policy and they put in $50,000 a year contract premium. That's a premium deposit, right? In year one. Plus they do something what is called a dump in. Now, this is very unique to infinite banking. You can do an upfront deposit as well of a large amount. That really gets your cash value very high early on. We call these HEC-Vs, high early cash value infinite banking policies. So this person put in $150,000 in year one. Okay. Now this compounding will start to take effect. Now, what I want to show you is I'm going to jump to year 8. So in year 8, this person's policy grew by $66,722. That's how much it grew by. The cash value available is $531,000 in this policy. But let's look at the growth here. Now, how much did they put in? Well, the cash injection in that year was only $48,593. Okay, but it grew by $66,000. So what is that? That's an $18,000 growth on the money they put in there. That's a 37% cash on cash return. Let me ask you all a question here. Who wants to have a 37% cash on cash return on your money? Anybody want to give me a 1? Give me a yes. Give me something in the chat box. Yeah, 1 on 1 right there. Anybody else want to have that kind of a cash on cash return on your money? Yeah, yes, yes. Scott says yes all day. Absolutely. And guess what? With infinite banking, it gets better and better. I mean, there's a point which it's actually like 300%. So, and you can, if any of you can do the math, you can see it on this page. There's a point here where it's like hundreds of percents. It's just powerful. Now, let's make it even better, right? Because 37% cash on cash return is awesome. I love that. But let's make it better. So let's say you go and private lend the money out. So when you private lend money, it's typically like around 12%. So I've been a real estate investor in the past. I'd use private or hard money lenders, 12%. So how's the math work? So it's 44%. So you private lend the money because you can borrow from your policy. You can lend it out at 12%. You're already making 37% on the money. And your loan rate back to yourself, let's say it's 5%. They're about 5.5% right now. 5%. So the math there is you're making 44% cash on cash return on your money by using this policy. But we did nothing different except where our money goes first. It went through the policy first, because if it didn't go through the policy first, how much would you make on the money? 12%, because you private lend the money. But by going through infinite banking first, you're making 44%. So the question is very simple. Would you rather make 12% private lending or do infinite banking and private lending at the same time and make 44%? We call that, it's called the AND method, by the way. You're not doing one or the other. You're doing both of these at the same time. Because even though you took money from the policy, you're still earning the 5% dividends. So it's compounding. You don't lose that growth right there. That's why the cash on cash return is 37% in year 8. So it is just extremely powerful. Now, this is what I want to talk about. So this is the power of compounded interest. I'm not going to go through all the numbers here, but really quickly, in this example, the client put in a dump in, we call it, of $50,000 up front. That jumped their cash value up very high within 30 days. They're putting in, let's see, around $5,895 per year. And so the cash on cash available, or the cash on cash return in year 2 is 21%. Access to capital is 121% in year 2. Year 10, cash on cash is 54%. Access to capital is 154%. You see how the numbers are getting better and better and better every single year. So these are 5-year increments. Year 20, cash on cash return is 191%. I mean, I don't know of any vehicle that does that. Access to capital is 291%, meaning you have access to a lot more money than you've even put into the policy. So that's why this is the marathon, not the sprint. But you can see even within the first handful of years, this thing is just crushing it. It is crushing it. And this is not even including what they're doing with the money outside of the policy. Yeah. Yeah. So Jane's a good question right there. Why is the death benefits being reduced after the 8th year in the previous table? So I'm going to go and show that here in just a moment, why that happens. That has to do with the MEC ruling, which I think somebody else already mentioned the MEC, but I'll explain that here in just a moment. But great question right there. All right. So when it comes to being a millionaire, how do you eat an elephant, right? We all know the answer. It's one bite out of a time, or one bite at a time. And the other kind of saying that I like when it comes to infinite banking is the man at the top of the mountain didn't fall there. He climbed his way there. So we have to understand that to get to where we wanted to go, we've got to take actions today, one step at a time, one bite at a time. You'll get there eventually, right? We'll get there. Yeah. Now this is kind of a weird one. Is it possible to owe no man nothing? Now, yes, because this machine works for debt and expenses. So it works for everything: vacations, homes, taxes, everything. So it works for a lot of things. Now, somebody already mentioned this, and I want to share this really quickly, and then I'm going to share with you guys here in a moment my call link, so you guys can schedule a call with me. Now, if we continue to pay back the home, remember the doctor, the 45-year-old doctor, had that a lot of debts. Now, let's say if we continue to pay back the home and the condos as promised, what would it look like? This is kind of scary, by the way. And Lavinia, I see your question there too. I'll answer that in just a moment. So if you paid them back as promised, 251 months for the condo, 224 months for the house, the total amount you'd pay back is $493,000. Okay, on those two debts. That's if you paid them back just as you're supposed to. So now at the end of those months, you'd have no more debt and you'd own those two things outright. Okay. But by using the money multiplier method, you can have that money back into your pocket, into your account, rather than the bank's policy. Okay. So what's that look like? Let's do it. I'm going to use 4%. Okay. Instead of 5, but it's actually 4%. But I'm going to use 4% on this example. Okay. Now, because your policy has a guaranteed growth rate of, it's actually, by the way, there's a guaranteed rate inside here, but I'm going to use dividend rate of 4%. I'm going to be very conservative. I'm removing a percentage point just to show you how powerful it is, even at 4%. So the actual amount that you netted from paying off your condo is $344,000. And from your house, the amount that you netted is $405,000. So that leaves you with a total of $749,000 in your policy. Plus you have the house and the condo. Now, if you don't understand the math of what I just said, here's what I just want you to understand. If you used a bank, you would pay them $493,000. That's the math right there. Okay. If you used a bank, you'd pay them that. If you use your own bank, you would have the house and the condo, and you would have $749,000 of cash value in your policy. That's a swing of over 7 figures, by the way, of over 7 figures just by using infinite banking. Now, if you're saying, well, how does that work? This is what we call the gain projector. So this is another tool that we have that shows you how to use infinite banking. This one shows you how to use it for investments, by the way. So if you want to use it for a house, like I just showed you, the condo, the house, this will show you, okay, if you go and use a bank loan, it'll be this. If you use infinite banking, it'll actually be this. It'll show you the amount of cash value and wealth you're going to build over over time frames. This is a tool that we use with our clients, and there's no cost to this, by the way, but it's something that we do for all of you. So because a lot of people, when they look at infinite banking, they say that sounds great, but how do I do that? What's the math look like? How do I flow the money? All these kinds of questions. And so we have figured this out. We figured it out for you. And so we have built these tools for ourselves and now for you. So we open this up to anybody who is one of our clients or our members. So kind of keep that in mind. But this is called the Gain Projector. And we have another one too. I forget what it's called, but we have multiple different softwares. All right. Now that you know this, everybody should do this. That's just my opinion, by the way. But the reason why I say that is that if you don't do this concept, you're stealing from your children and grandchildren. The reason why I say that is because, and I'm going to show you, I got more slides. I'm going to break down some more numbers based upon some of the questions I saw that have come through before. So I've got some more numbers. I'm going to show you the death benefit, why it reduces, things like that. But bottom line, wealthy families do this because they're setting up their children and their grandchildren's futures. I mean, literally, they're guaranteeing generational wealth. And it's mind-blowing to me that, you can guarantee that tax-free, by the way. So should you do this for yourself? Yes. Should you do it for the next generation? Absolutely. Okay. And if you guys want to see how we do that for people, all you got to do is go to brian.beyourownbanker.com. That's my personal calling. You actually be speaking personally with me. I don't have my link in there. Shauna, if you're there, can you put my call link into the chat box? I forgot to put it there. And then also, I'm going to put into the chat box, I'm going to put in my personal email address so that if anybody wants to get those ebooks that I talked about, the 2 ebooks up front, go ahead and send me an email and I'll just send you the link to those digital books. Okay. And then, yeah, thank you, Sean. Appreciate that. And that's my personal calendar link right there, brian.beyourownbanker.com. Okay. Now, by the way, we're not done. I got more slides and stuff like that. So, but I'm going to answer Lavinia's question really quickly here. Brian, would I be getting in backwards if I borrowed 15K to start a policy? Great question, Lavinia. It depends on how you borrowed the money. That's the simple answer. It depends on how you borrow it and where you borrow it from. Okay. So if you're borrowing it from like a credit card, I probably would not recommend it. If it's something like a HELOC, yeah, there's lots of ways you can do it there. So yeah, so it depends on how you're doing it and where you're borrowing it from. But you can send me an email if you want to clarify that question, or you can schedule a call with me, of course. And guys, any questions you have, obviously, please go ahead and reach out to me. All right. So this is kind of the flip that we're talking about here. And I had this conversation with somebody here yesterday. So if you're trading time for money, you have a job, all that kind of stuff, you're working for your money. There's nothing wrong with that, by the way. I do that. We all do that. But the flip is when you start having your money work for you. Make that money work for you by being your own bank, because that's really where it starts to change things. I was talking to a gentleman. He's 65 years old. He's a doctor. No, he's an auditor. I can't remember, something like that. And he's realizing that, hey, I'm working so hard, but I cannot work any harder. I can make a bit more money, but I just, man, I'm so tired of working so hard. Then when he looked at infinite banking and we walked through the numbers, he realized, holy cow, my money's going to be working for me all of a sudden. And there's always that comment that I hear every single time. I wish I had done this 20 years ago. Very common statement right there, because once you see it, yeah, it definitely changes things. So let's kind of clarify a few things about infinite banking that we haven't touched on just yet. Lavinia, so if it's your credit union you're borrowing it from, it just depends on how you're borrowing it. If it's just a loan, personal line of credit. If it's a personal line of credit or a PLOC that is a revolving, that can be a good way to do it with another concept. You kind of combine 2 concepts and it can work. It can work well. Yeah. So let's kind of talk through a few other things about infinite banking that are really powerful. So one of those is the death benefit. I'm going to talk more about the death benefit and what that means. Now we talk about loans, right? We're borrowing from these policies. We're talking about policy loans. Well, here's the thing. Loans never have to be repaid. I'm going to talk more about that. The internal values inside these policies, they grow tax-free. As I said, I don't mind paying taxes, but I like paying less more, right? So these grow tax-free. The policies are exempt from judgments and liens in most states. So your money is protected. Think of other investment things you have. They're not as protected as this is. Tax-free income in retirement. Yes, you can build these to have yourself or build a tax-free income in retirement. So a lot of people are liking that because they can use the policy for things like investing and then also use it down the road in retirement. Now let's kind of talk about the death benefit. So what you'll notice is that there's always an increasing generational wealth or generational wealth strategy through the death benefit in these policies. So you'll see there on the right-hand side, it starts out at $325,000 death benefit, and then it keeps growing year after year after year. Now, I had a question here a bit ago. Someone asked about why did the death benefit drop down in like year 8? Yeah, so James asked that question. So here's why that happened. So when you're doing what we call dump-ins, like if you put a large amount of capital into the policy up front, we call that a dump-in. In order to abide by what's called a 7-year or 7-pay MEC test or modified endowment contract test, we have to increase the death benefit temporarily for those 7 years because the test is over 7 years. And we do that with a 7-year term rider that then drops off after year 7. So the death benefit is high for 7 years, and then it reduces after year 7 because we no longer need to have that rider on there. But we were able to get a large amount of cash value and accelerate the growth of the policy by doing that. So it's a massive benefit for people that want to have a large amount in upfront. So that's why it dropped off. If that doesn't make sense, let me know. And then, Michael, what's our favorite insurance company to use? So we use a very, a handful of companies, One America, Lafayette, Security Mutual, some of the main ones. There's about 10 companies that do this. They all have their different types of ways they do infinite banking. The ones that we use are very pro infinite banking. So they have products and resources for infinite banking policies. That's why we use them. And we have resources with those companies. Okay. Now let's talk about the policy loans for a sec, because people have questions about these policy loans. What are they? So one, they're guaranteed. They're a guaranteed loan. So if you have cash value in the policy, you are guaranteed a loan. So there's no credit check, there's no approval process, nothing like that. Ask and you shall receive. The loans are private. They do not go on your credit report. That's kind of cool. So when you think about debt and when you're moving debt into your policy, essentially what you're doing is you're removing it from your credit report. So it's a really cool thing that it does. And when you borrow from these things, from the loans or from the policies, it doesn't show up on your credit report. Okay? There's no minimum or maximum payment. So when it comes to paying the loans back, you're in control. Remember talking about control? If you have a car loan as an example and you don't make a payment, what do? Take your car. If you have a policy loan from your policy that bought the car and you don't make a payment, for 3 months, what happens? Nothing happens. Nobody's calling you. Nothing's happening. So you are in control. Miss a payment, nothing happens. Okay. Jeff asks, are you guys licensed insurance agents? Yes. Yeah, yeah. So I'm licensed in 49 states, I think. There's like 1 or 2 states where I haven't had a client. But yeah, we're all licensed. But by the way, Jeff, so we're also all entrepreneurs. So we are investors, we're entrepreneurs. I own a golf ball business, I own an education business, I own email lists. So we're entrepreneurs and do other things as well. So a lot of real estate investing. All right. So the other question I get quite a bit is, how can I fund my bank? My bank. So you can do it monthly, you can do it quarterly, you can do it annually. Okay. Now, a lot of questions are around is how much can I put in, or what's the minimum, etc. So the minimum is 10 times your age per month. So if you're 50 years old, 500. If you're 40, 400. Okay. The maximum depends on the individual. So it's going to depend upon the gross income of the individual that's being insured. So it's a sliding scale, by the way. And so I would just work with you on what that number is. But it's going to be a percentage of typically gross income, including business revenue as well. All right. On top of premium deposit, can I fund a policy upfront with a large dump-in? Yes, you can. Yes, you can. So like as an example, someone's going to put in $1,000 per month and they want to do a $50,000 dump-in. Yes, we can do that. And so we just work with you on what you're trying to do and make the policy as optimal and efficient as possible. Michael, is that minimum your rule or the insurance company's rule? So good question. So the maximum is the insurance company. The minimum is typically our rule, because it's very, very difficult to build a policy that's infinite banking structured if you're doing something less than 10 times your minimum, less than 10 times your age per month. So to make it work and make it efficient, typically 10 times your age is right around that. Now, we can go under that sometimes. If someone's doing like a dump-in, we can go under, but it's just on a case-by-case basis. Now, when you fund the policies, how much goes to cash value? So as we said, this is a marathon, not a sprint. So in the very beginning, the first handful of years, there is a cost to doing business, to doing this concept. So a dump-in, 90% goes to cash value within 30 days. of the premiums, it's anywhere from 50 to up to 85, even 90% on some cases goes to cash value, depending on the individual, what we're trying to do, how it's structured, all that kind of stuff. Because these things, by the way, so these policies are built for you. They're not one size fits all. They're specially designed insurance policies for the individual, what we're trying to accomplish, your numbers. So that's why we say infinite banking is definitely a bit different. It's also why about 99% of other people out there, life insurance agents, by the way, can't do infinite banking because they don't know how, and they don't understand the things I just said, how to structure these things. And the last question I always ask people is when they talk about funding the bank, would I put in? Would you want to put in $1 in order to get $3 out? So when you fund these things long term, that's what you're going to see. You're going to put in $1 and get $3 out eventually. So what do I mean by that? I'm going to show you exactly what I'm talking about. So this is a policy illustration right here. And James, if you're still on, you're going to see the same thing here that we talked about before. Great question, Jeff. I'll answer that one here in a moment. So on this policy illustration here, initial annual premium was $10,000 per year. So this person's putting in $10,000 per year. Now they can do it monthly, they can do it annually. They're doing it annually, but it's up to you. They're also doing a lump sum or a dump in of $50,000. So in year one, $60,000 goes in. So here's what I want you to show. So I want to show you. 60 goes in. They have $55,535 of cash value available. Now that's the end of the year. This is the end of year thing right here. They're going to have probably around 51 or something like that in the first 30 days, maybe 52, something like that. But they have $55,000 of cash value. They also have $1.1 million of guaranteed generational wealth death benefit at the same time, day one. Now, in this one, you'll see in year two, they put in $10,000 and they have $10,607 of growth. So they have more money available than they put in year two because they put in the large dump in, by the way. That's what happens on the dump ins. They make the policies efficient very quick. Additionally, you'll see in year 7 and year 8, on the left-hand side, the premium drops down from $10,000 down to $9,388. It drops down because they have a 7-year term rider inside this policy to allow that $50,000 lump sum dumping to occur. I won't get into why that occurs. If you guys want to get into the MEC, I can do it here in a little bit, but it's called the MEC test. And you'll see in year 7 and 8, the death benefit drops off too because they don't need that anymore. Okay, so that's how this policy works. But let's go look even further down the road. In year 11, this person puts in $3,120 because you can drop the premiums down, by the way. The premiums in these kinds of policies are decreasing, not increasing. They can decrease if you want. So in this case, we drop it down to only $3,000, and yet the cash value grows by $10,590. I mean, they're more than 3xing their money. So what's that cash on cash return there? That's over 300%. That's over 300%. That's amazing. And it gets better and better every single year. So that's how this is very powerful. All right, Jeff, great question here. You said, does the policy have to be on myself? No, it does not. No, it does not. Given my age and health, I doubt I would pass a life insurance medical exam. Can I get all the benefits with IBC if I insured my grandson? Yes, depending on some different scenarios. So to insure if it's a minor, depends if it's a minor or an adult, by the way, that changes it. And then it depends on if the guardian of the grandson is also insured. So the way the insurance company looks at it, they're going to look at the guardian or parent of the grandson first for coverage. And then you can insure typically the grandkids. So there's a little bit of flexibility in that, by the way. But yeah, I can walk through those numbers with you. Just schedule a call with me and I can go through it. Michael, great question here. You say generational wealth, meaning they make the beneficiary the next generation. Yeah, so the death benefit. So the death benefit can go to your kids, things like that, and it's passed on tax-free, guaranteed. So that's generational wealth. So think of like the Rockefellers. How do the Rockefellers and wealthy families, how do they get wealthier and wealthier and wealthier every generation? It's crazy, right? Well, guess what? They have policies on everybody, and the beneficiaries is the family trust, by the way, Mario. And so every generation, multiple 7 figures are passed on tax-free, right? That's how it's happening. And so think of it this way: if you are a wealthy family and you say, hey, if I put $1 million into a policy on Bob, and I know that $1 million is going to turn into $3 million when he graduates, as we call it, passing on, going to turn into $3 million tax-free guaranteed, Oh my gosh, am I going to do that? Absolutely. Absolutely. That's how these wealthy families, every generation is wealthier. And they can use the policies in the interim to build more wealth. Pretty cool. Yeah. All right, let's kind of keep going. Now, this is an interesting kind of a quote by Warren Buffett. It's I kind of agree with it, but I kind of don't. But it's if poor people would just do what the rich people do, they wouldn't be poor anymore. Now, granted, things like infinite banking, you do have to qualify for, right? But you have to be aware of it first. So that's what we're doing on this presentation is we're talking about infinite banking. We're gaining knowledge. So the wealthy, they have knowledge, and we're just sharing that same kind of knowledge. Now, a question I get sometimes is why should I work with you, Brian? So let's kind of talk about, who I am. So I've been teaching IBC or infinite banking concept for over 7 years. I built a course on it years ago. That's how I got into it. We hit the Money Multiplier. We have an entire team that works for you to set up infinite banking. So it's not just like one guy. It's not like you going down the road to your parents' financial advisor or agent and saying, "Hey, can I get a cash value life insurance policy?" They'll be like, "Oh, yeah, probably." But the first thing you're going to ask them, if you ever want to do this, by the way, this is what I recommend doing. If you say, "Hey, I want to go do this, but I'm going to go talk to my life insurance agent, my financial advisor, my parents' financial advisor," ask them if they have this for themselves. Do they use it? Do they use this concept in their own lives? If they don't, run away. Run away, in my opinion. So our team, we are one of the largest, if not the largest, infinite banking producer in the US, mainly for the big companies that we work with. But we do that because we have an entire team behind us. It's not just me and like one other person. We have a team behind us doing different things for you as our clients. So I have personally right now over, I think it's 100 clients in underwriting right now going through the process. We also provide ongoing support and services because if you're going to be successful doing infinite banking, you have to have ongoing support. You need to have somebody you can turn to for help for, "Hey, what should I do here? Hey, I want to go do this. What would be the best way to do it?" You need that kind of support. And that's what we do on an ongoing basis. We do it also at no cost to you. We don't charge you anything. If you guys want to understand how we get paid, I'll tell you. But yeah, there's nothing we charge to you. The other question I get quite a bit is IUL or VUL infinite banking? Straight answer for us is no. No, it's not. IULs and term insurance, they pay some of the highest commissions, but they're not infinite banking in our opinion. Okay. Now, we take a 70% cut in commissions to do infinite banking. That's why a lot of people, agents, by the way, don't do infinite banking because they cannot do that. We can because we have a team behind us. So it's a very large cut in commission to do infinite banking. So there you go. And then also, if you look at the Nelson Nash Institute, so there's an institute called the Nelson Nash Institute that certifies infinite banking practitioners. Okay. If you touch an IUL or VUL, they will not certify you. In fact, they will pull your certificate away from you, right? And the biggest thing that we have when it comes to exchanging policies. So by the way, not to get into the weeds, but you can exchange a permanent life insurance policy for another one. It's called an exchange. Guess what the most common exchange is from into infinite banking? IULs. It's IULs. I mean, you'd be shocked at how many of those come across our desk all the time. So yeah, so Greg says, if I have an IBC setup policy already, how do I become a member? That's Stephen can answer that question. Yeah, depends on what you mean by membership, by the way, too. And then, by the way, we only do infinite banking. So we don't do car insurance or health insurance or all that kind of stuff. We just do infinite banking because it's what we do. It's what we use in our own lives. So yeah. Let's see, another question over here. So Luvania asked, how do we get paid? Great question. So we get paid on commissions from the insurance companies. So typically, mainly first year only on commission, but it's a smaller percentage based upon other ones. So like if you look at an IUL, it can be anywhere from 75% to 115%. I mean, it can be a lot. Ours are around, I think it's around 15%. Something like that. It's pretty small compared to like other insurances do. And term insurance, by the way, I think it is the most profitable insurance out there because it only pays out about, I think, 1% of the time. It's a very small number. So have you ever heard the term buy term, invest the rest? Gee, I wonder why they're saying that. Because they own term insurance policy companies. It's the most profitable insurance out there. So yeah, so all right. Now I got a few more slides and we'll wrap it up here. But once again, any questions you guys have, please obviously use that chat box. And then I think, let me see, I'm going to put my call link back in here one more time. All right, so there's my calendar link right there. And then I'm going to put my email address back in here one more time. So if you guys want to reach out to me personally, feel free to go and do that. If you want the ebooks, the digital ebooks I mentioned in the beginning, just go ahead and send me an email and I'll get those over to you real quick. Yeah, there's my email address out there. So in life, what happens? Well, there's two things we know will happen. We're going to live, right? We're going to live. Anybody want to guess what the second one is? We're going to die, right? We're going to die. So are we better off with infinite banking in our lives while we are alive? Well, you just saw the living benefits. When we die, are we better off with or without this? Well, you saw the generational wealth aspect. So what I mean by that is this. So someone's asked, well, what do you mean by generational wealth really? So let's say you have a 401k and you pass away and it's $100,000. Okay. What's going to happen? $100,000 is going to be passed on. If you have $100,000 in infinite banking, the death benefit is going to be significantly more than $100,000. It's going to be, let's say, $300,000. So you turned $100,000 into $300,000 for the next generation, and you change nothing other than becoming your own bank. Quick little story. This is kind of something interesting. You may have seen this kind of a presentation in these before, but I called this a tale of two people, right? There's the guy on the left, the guy on the right. First one is group one. Group one is the one that says, hey, I learned this concept, but you know what? I'm fine. I don't want to do anything new. I don't want to try something out. I don't want to learn more about this kind of stuff. Now, here's the deal. If you look at, our lives and our economy and the world as a whole, wealth is always being transferred. Okay. It's coming from somebody and going to somebody else. Which group do you think it's coming from? The group that takes no action, that doesn't learn about these kinds of things? Absolutely. So group one is typically the one that doesn't do anything different. Like they just hope that they're going to keep doing the same thing and get different results. That's the definition of insanity, by the way. They don't do anything different. That's the group that typically loses wealth when wealth is being transferred, which, by the way, is always happening. But then you've got group two. Group two is that one that says, hey, I learned something new. I want to see what this is. Is this a fit? They take action. Right? This is the group that says, hey, I want to take action. I always want to be improving. I always want to be learning, right? Because you ever heard that concept of when people retire and they stop doing anything, they don't live very long, right? Because we as people, we always want to be growing, be learning, gaining more knowledge, right? That's my opinion, why we're here. And so I want to be in group two. I assume that most of you guys here want to be in group two as well. But group two is the one that wealth is transferred into. They're the ones that receive that wealth when it's transferred. That makes sense? So group one, go it alone. By the way, that was me. When I first learned about infinite banking, this was me, group one. I went alone. And I did. And by the way, thanks, Jeremiah. Yeah, thank you. Appreciate that. But yeah, group one was me. So when I first heard about this, I went to my financial advisor, who I considered a friend back then, not anymore, for other reasons. And he goes, oh yeah, I can do that. I can do infinite banking. And I was like, okay, cool, do it. But I said, but I didn't want to learn about it. I said, okay, just go do it. And he set me up. I lost tens upon tens upon tens of thousands of dollars of future wealth because he did not set me up with infinite banking. He took advantage of me, by the way. He set me up with a policy, but it was a high commission policy that did not benefit me. It benefited him. So I was in group one. I tried to go it alone. I didn't go to the person that told me about it. I went to somebody else, and it hurt. I'll be honest. Group two, that's the group that says, hey, if I want to do this, go learn from the best. There are lots of people that do infinite banking. I feel that we are one of the best out there. Chris Naugle is one of the best on YouTube. So it's very simple. Just hop on a call. Let's just solve your problems. Let's just answer your questions and see if it's a fit. Because I'm not going to sit here and tell you that infinite banking is a fit for everybody. It is not. It is not a fit for everybody. We want to make sure that it is, though. And so if you don't know, let's just find out. So once again, just go to brian.beyourOwnbanker.com. The link is in the chat box up there a little bit as well. And then once again, go to brian@chrisnaugle.com if you want to send me an email and get those two digital ebooks. So I'm gonna end the presentation on this quote, because I just like this quote. The problem in America isn't so much what people don't know, it's what people think they know that it just ain't so. I love that quote right there, because hey, if you don't know something, let's learn about it. Let's talk about it. Let's get into it. Yeah. No problem, Jeff. Yeah, thanks for being here. So that being said, guys, any other questions you guys got for me? Any last minute questions? Thanks, Jay. Appreciate that. Yep. It is my birthday. I don't know what we're doing today for my birthday, but my family went out yesterday and got some stuff, so we'll see. Maybe I might go fishing or something like that here in a little bit. Yeah. Thanks, Kevin. Appreciate that as well. All right, guys. Oh, so Michael, so how do we work with you to sell these policies? So Michael, you can reach out to me via email. Yeah. So reach out to me at brian@chrisnaugle.com. Send me an email and then we can go from there. Yeah. Yeah, because the one thing here is the one thing. And this is a thanks, Chris. So Michael, is we don't sell these policies. We don't sell anything. We teach the concept, and then if you want to put a policy in place, that's awesome. But yeah, that's one thing I always get. It's kind of for me because I've been in sales before, and I'm always like, sell, sell, sell. But with infinite banking, my goal is to teach you and educate you first, so that then you can become your own banker and be successful using the concept. Because if that's the approach that we do, guess what's going to happen? You come back again and again and again. So we are one of the largest producers of infinite banking because we have referrals and repeat clients. Yeah, because once you have that knowledge, man, it's you don't have to sell anything. It's kind of cool. So yeah, so that's why we do these presentations, by the way. So yeah, great questions, by the way. Yeah, and love all the questions. So with that, everybody, unless there's any last minute questions, I'll let you all get back to your Tuesday, and I'm gonna go see what my kids are doing. Hopefully they're up already, because it's only 11:45 where I'm at. Cheer. One question. Yep, Lavinia, no problem. Thanks, Michael. Appreciate that as well. Look forward to hearing from you. All right, guys, everybody take care. Have a great rest of your day, and hopefully I'll talk to some of you soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.